the expectation was for headline CPI inflation to come down a little bit in June, and it did, from 5.2 in May, as you pointed out, to 4.9% in June. And I think this is an encouraging signal going into tomorrow's rate decision, because if you think back to the May MPC meeting, the South African Reserve Bank came out and started to sound a little bit hawkish in its language, almost as if to signal that it was preparing the market that it may want to hike interest rates very soon. And one of the things that they did say specifically was that they were starting to see risks to the inflation outlook as tilted to the upside. So I think seeing a print like the one that we saw today, headline CPI inflation coming down to 4.9%. And of course, some of the other drivers that we were concerned about, like food inflation, seeming to stabilize a little bit in the June data. And of course, as you would have seen in the last few days, oil prices, which rose quite sharply, as recently as last week, we almost touched $80 a barrel. After the OPEC announcement, oil prices actually collapsed quite sharply, and we're now down to about $70 a barrel. So as things stand right now, it does not look, in our view, that inflation is something that the SARB should be particularly too concerned about, at least not in the short term. And we believe that gives them the scope, at least, to keep monetary policy settings relatively accommodative.
Yeah, but just to contradict you there, in the short term, aren't there concerns about inflation, given what's happened in terms of the riots and, the supply chains having been disrupted by the looting and all of that, the burning of trucks, the closure of the harbours, the N2 and N3? There are worries that in the short term, people are going to, there's not going to be much available, and some people will take advantage and raise prices on goods.
And I think that's a very valid concern. We at this stage, it's obviously very unclear just what that impact is actually going to be. But I mean, we've certainly been hearing that there could be some shortages. There's certainly been some supply chain disruptions. But I think over the last few days as well, we've also started to hear a lot of firms, and I won't necessarily mention them by name, some of them in the food space, some of them in the transport space, coming out to say that, yes, the impact was quite bad, but things have started to normalize. And I think pretty soon we're going to start to see the movement of goods around the country sort of getting at least close to where we were before this shock hit us. So it's possible that I think we could see, as you point out, in the very short term, some price effects, for instance, for some of the things that there may have been some shortages. But we don't think that it's going to be a prolonged effect. We think those price effects are going to be very localized in those areas that were most impacted. And we certainly think it's not going to be long-lived. We certainly think the impact is going to be very temporary. And obviously, from a monetary policy perspective, I think the SARB would not want to hike interest rates, because in the short term we could see sort of a temporary price spikes. The South African Reserve Bank is always interested in not just the price shock itself, but how that actually generates second-round effects and where the medium-term trajectory for inflation is actually going. And in our view, we don't think that the medium-term trajectory for inflation is going to be significantly affected by the supply chain disruption and, of course, the effects of the looting and rioting that we've seen over the last couple of weeks.
Yeah, and then to the million-dollar question, tomorrow's decision in terms of the rate decision, do you think they'll hold, hike, or cut even?
I think they will hold. And I think we just have to sort of think back to where we're coming from here, Anombu. And the cycle that we kind of in started last year, right? The pandemic shock hit us, and right at the start, it was pretty clear that the effect on domestic economic activity was going to be quite severe. And in response to that, the South African Reserve Bank came out quite strongly to cut the repo rate by 300 basis points over the course of last year. And because that was based on the view that given the impact of the shock that we're going through, this economy is going to need as much support as we can give. And of course, they delivered that interest rate easing. And I guess the question now is, with all that easing that they've delivered, when should they start withdrawing some of that monetary policy support? We don't think it is time to do that right now. We believe they will be on hold, not just tomorrow, but we believe they will be on hold for the remainder of the year. And that is because that although we have seen some recovery in economic activity, if you look at the overall GDP level here in South Africa, or which you can call total output, it's still not back at where we were before the pandemic. And when you look at employment, we still, at least on the latest data, we're still down about 1.5 million jobs compared to where we were before the pandemic. So that is still an economy that still has a very long way to go to recover just the losses that we've experienced as a result of the pandemic. And of course, more recently, we've had the third wave that came with its own lockdown restrictions. That's going to dampen growth momentum a little bit. And of course, the rioting and looting that we had over the last couple of weeks, that'll also create a little bit of short-term uncertainty around sort of the growth impact. And we also don't really know how that is actually going to affect sort of longer-term business confidence as well. So in our view, at this stage, there isn't much that suggests to us that the SARB should be in a hurry to normalize monetary policy. And we certainly believe that it's going to be a unanimous hold tomorrow, and we certainly expect them to keep rates on hold for the remainder of the year.